I could clearly see that the way traditional banks, especially the large ones, were consolidating around bad culture. There was bad payment culture around business transactions that have a regulatory aspect, a transparency aspect, the need for efficiency, the need for liquidity. And so the entire payment ecosystem was designed to consolidate rather than to flourish it or bring about any progress in it. And this was the sort of challenge that we had to take on when we started, where we had to use technology as an entrenchment instrument, where you try to solve some of those problems within the value chain around payments, the context of the payment, the reconciliation, how that payment trigger creates efficiency in the logistics of the freight, and how it solves the problem of reconciliation and credit management. So this was what we thought, a space that typically a large ERP provider would have probably solved. Turned out they didn't, or a bank would have usurped that territory and they would have tried to solve that problem, which is where we sort of sat in the middle, and we worked with our partners who allowed us to create that interoperability in terms of the banking transactions. And the idea was, because this is highly unbanked, it likes to remain transparent, it's very shy in terms of financial inclusion, it had to begin with corporate sponsorship. And so the bulk of the effort was on trying to create these technological intermediations for the large corporations, which is where we've always focused, and then let it trickle down. And quite frankly, in the first 2 and 3 years, that had to be proven whether the trickle down effect does come into place. But now at where we are in our journey, where we can clearly see that the trickle down works, simply because corporations and post-COVID, they want the efficiency, they want to minimize human interaction, they want to reduce their order to cash life cycle, they want to make sure there's excess formal liquidity that's available so that they could make those decisions a lot faster, and especially around peak seasons where liquidity is needed so that the financial sector could quench that thirst. So I think it's really the beginning of this journey, because the way you mentioned, it's way below 1% in terms of digitization. A lot of banks are supplying cash management solutions or financing solutions, but it's still very premium, and the focus is on what I call that the journey of the customer still includes the customer having to visit the bank, or the customer trying to go to the bank to get something out of it. What we've tried to gradually do is shift the power of corporate banking back to the corporation. That's where it needs to be. That's where the decisions need to take place. So that journey obviously is going to take some time, but there's good momentum, especially with the regulatory, sort of tailwinds that you get, whatever's happened after COVID, and generally the efficiency in itself feeds into the argument that we're building. I think it's barely the beginning. There's a massive market out there, because like you mentioned, it's 20% of the GDP. It's a huge churn that remains to be digitized.
Thank you, Omer.